Welcome back. Welcome to the course Introduction to Commercial Banking and FinTech. This is lecture 4, and in this we will be talking about monetary policy instruments. So, in the last section we set up the background. So, in this particular lecture we will be focusing on particular policies. For example, in the last lecture when I was explaining the money multiplier adjusted reverse repo. So, reverse repo, what is that? What are the instruments? So, if you remember in the first class we mentioned about the Narsimham Committee 1991 and 1998 and how those policies had impact and how the policy framework has moved. You might be reading in newspaper about the policy change by RBI. So, when RBI is going to change the policy rate, which is the repo rate, then how it impacts. So, repo rate is the rate at which the central bank lends money overnight to banks, and reverse repo when banks keep money with the RBI at the nominal rate whatever RBI offers, and it is also overnight characteristics. But there are other types of instruments which we may not be reading or you may not be aware. So, if you go on RBI website, it mentions about some other instruments. For example, you will be we will be discussing about cash reserve ratio. So, in the previous section we just took RR, right. So, RR was required reserves plus the excess reserves. Now, here we will be introducing that formally. What is that RR exactly in practical life? So, and then here you have the bank rate, then marginal standing facility, then market stabilization scheme. There are other schemes like operation twist, that how the central bank twist the yield curve just to make sure that short term and long term bonds remain in demand whenever they want, and they can create that scenario. Exchange rate management, which is one of the important objectives of the central bank. So, you can say that we are going to cover most of the things that you should be knowing, or you should always be knowing about when you want to understand the banking sector in a big way. So, let us go one by one. So, let us first understand the aspects. So, here we talked about the I will come back to this particular chart again, and then we will see that how it works. So, let us understand first is the monetary policy instruments in India. So, what is the objective? Objective of the central bank is to maintain price stability while supporting economic growth. So, there are different types of instruments. So, first is the price based, which is the policy rates. So, the price based that we often say, it is the repo rate. So, in India it is the principal policy tool. So, repo rate here we have. Then there are corridors, which means that within range that we talk about. So, this will be like within a particular range that we talk about. So, this is corridor. So, then it is called special discounted facility. So, here it is SDF. Reverse repo, it is also a floor, and MSF, margin standing facility, is the ceiling. So, this is what the price base talks about. So, repo rate is the policy rate, SDF is the lowest point. So, if this is what is the upper, so this is what is the ceiling, and this is what is the floor. So, this is what it says, and SDF and reverse repo are here, and MSF. So, here we have the corridor created for borrowing lending at price. So, these are the price based instruments. So, this is what it mentions about. Second is liquidity management. So, liquidity management, how it is done? It is done through it can be done in overnight basis, or it can be done on term basis. So, here this is what it mentions about. Then here we have the variable rate repo and reverse repo, right. So, variable rate repo is this VRR, and reverse repo auctions are these variable rate. So, I will come back to this, what is the meaning of variable rate repo. These are the slightly a longer duration, maybe 7 days, 15 days, 30 days, sometimes they are also used for special purposes. So, this we will be talking about. Then this is about the liquidity adjustment facility. Liquidity adjustment that we talk about, adjustment in the sense that when there is a increase in money supply, when the when we say that price level is increasing, then at that time we go for adjustment. So, we increase the rate of interest, which means that repo rate goes up, as a result borrowing cost goes up, and lot of lending and borrowing activities are disrupted. Variable repo rate and reverse repo rate is again the same that we talk about, that RBI. So, variable reverse repo rate, it means that banks want to keep money with the RBI, but RBI is accepting only up to 50,000 crore. Then it can go for asking banks that at what rate you have to bid, that at what rate you want to park your money with the RBI. So, lowest rate will get the preference, and then followed by the higher and higher, as long as they are reaching the 1000 crore limit. So, this is what. Third is the quantity based. Quantity based is the cash reserve ratio. What is this? Cash reserve ratio, which means that these banks, when they are receiving the deposit with the customer, so whether it is SBI, HDFC, ICICI, you go to SBI, deposit 5,000 rupees or 1,000 rupees, for example. If the rate cash reserve ratio is 10%, bank is supposed to keep 10% of 1,000 that they have deposited with RBI in the form of cash reserve. It will be with the bank only, but it will be finally counted with RBI, and then this cash reserve ratio will not attract any kind of rate of interest. It will be just a security purpose. Why we do it? Because in case banks are not able to make money, so this money will help them to recover. Then here we have a statutory liquidity ratio. It consists of the government securities, it consists of the precious metals, and any other instrument that you have. Even state government bonds are also considered under statutory liquidity ratio. So, this is what here we have. Now, other instruments are market operations. So, this we call it as open market operation, buying and selling of government securities. When we deal with, then it is called open market operation. We often call that as operation twist. And second is the market stabilization scheme, MSS, which is also one of the important. So, these are market based, which means that government is selling the bond, or whether increasing the bond sale or decreasing the bond sale, it is based on that. So, that is why we call it as open market operation. So, it is called gilt edge security market, which is the government bond market for the government and for everyone participating, including banking sector. Then another crucial aspect is about the foreign exchange operation. So, foreign exchange operation, it talks about spot, it talks about forward and swap transactions. Swap transactions again have two legs, one is at fixed rate and another is the flexible rate, and how two entities transact with each other. A spot is the market where you can borrow, you can buy and sell the currency of foreign exchange immediately. So, if you travel by airport, you will find that there are a lot of travel agencies sell the foreign currency. So, those are called a spot. And also on exchange, for example, MCX trades, even the NSE trades. So, if you are buying from there as on the spot, then that will be also called. Forward is somewhere you find that you want to borrow or you want to convert, you are expected to receive some amount of money from your loved one in US after 2 months, and you feel that after 2 months you are not sure whether rupee will appreciate or depreciate. If it appreciates, then you are going to lose money. If it depreciates, then, and if you are not very sure, you want to cover your risk. So, you buy a forward, that you will be buying the dollar at today's price. So, suppose at today's price, if it is coming out to be 85 rupees per USD, right. Now, you are going to get in Jan 2026, right. If it is going to be in Jan 2026, remember, then if in Jan 26 you are ready to buy at 85 in Jan 26, when Jan 26, when you reach Jan 26, you find that it is 87. It means that you can buy at 85 rupees and sell immediately in the market at 87. So, difference between 87 and 85 rupees 2, you have a gain, right. But in this case, but in suppose you are suppose the dollar has depreciated and rupee has appreciated, and if it comes out to be 82, then it means that you have purchased the dollar at 85 in the market, it is available at 82, it means that you are losing, right. So, you do not have the gain, and this is where the forward plays important role. It means that depending upon the expectation, you take a position today for the buying or selling of the currency in future at a particular date. When that date reaches, if it appears that it is less than or higher, so your payoff will be decided whether you are getting or losing, right. So, this is what we get. Open market operations, cash reserve ratio, market stabilization schemes are called sterilization measures also. Sterilization measures says that you have increased the money supply and you see inflation rising. As a result, it becomes very difficult for you to manage. So, what you do is that you sterilize the price increase by either increasing the cash reserve ratio of the banks, or you force the banks to borrow through market stabilization scheme, or buying and selling government security. So, basically you are taking out extra liquidity from the market. So, that is called sterilization, you are sterilizing. Targeted special facilities. So, long term repo operations, and then here we have the targeted long term repo operations. So, LTRO is the long term repo operation, which means that a government of India requests the RBI that you please help us in some sectors, so that liquidity can be improved in those sectors, financing can be done and it can help better. So, LTRO is about that. TLTRO is again the very specific one, and here we have the short term or special long term repo operations, which means that suppose for MSMEs, micro small medium enterprises, if the government wants to support them, then it can be also through that. So, MSME agriculture. So, long term operations, right. Targeted long term repo operations and special long term repo operations are some of the unconventional monetary policy measures, you can say unconventional. Government of India does not use every time, unconventional measures. We saw these measures were used during COVID-19, because that was a very special moment and at that time it became very difficult. So, unconventional measures were used at that time. There are different types of communication tools. So, first is the Monetary Policy Committee. So, Monetary Policy Committee in 2016, Urjit Patel Committee recommended for flexible inflation targeting, and it was decided that there will be a committee where in there will be nominations from the government. So, the government nominates 3 people and then RBI governor, deputy governors are the by de facto the part member of the committee. These people wait when they decide about the policy rate, whether increased or decreased. In case of tie of the vote, then the RBI governor has the veto that it can say yes or no, and then they take the decision. Nowadays, in the era of machine learning, in the era of AI, there are a lot of studies talking about the communication tools. So, I also work in this area. I have also published work. So, you can visit my web page and you can read about some of my work that I do in this area. So, what people are trying to do is that with the evolution of what we call it as the natural language processing, the textual data analysis, people are trying to analyze the data from the monetary policy statements released by central banks across globe, even on the banks for international settlements. Bank for international settlements, if you go on the website, they have the speeches data, historical speeches data. So, through textual analysis, they try to read the pulse of the central bank, that whether they are hawkish or dovish. So, there are 2 types of so whether they are hawkish or dovish. Hawkish in the sense that you are very much so when the moment you have the inflation rising, you react immediately. So, hawkish on inflation. Dovish means you react slowly, that even if there is a symptom of inflation rising, you take time and react. So, dovish, it means that it takes about the persona of the central bank governor, how is the governor and what is the attitude of the governor, and press releases, minutes, all these are now being read through machines, and then you can derive sentiments, and based on that you can say that whether the central bank minutes or press releases are impacting the market or not, what kind of information they reveal, whether we can get some sense about what is going to be the policy guidance in future. Then there are for example, forward guidance as policy is instance. So, there is a unconventional policy tool about forward guidance, which says that how central banks try to nudge the participants, market participants and everyone through their policy directions, that they will be saying that this year the rate of interest looks like on a tighter side. So, it means that RBI is going to increase the rate of interest. So, accordingly everyone will be adjusting decisions, but whether RBI will increase the rate of interest or what will be the stance, or whether RBI will be neutral, it is up to the RBI, but it gives signals to everyone that this will be the policy direction of the central bank. So, majority of the investors and all the participants, they take care. So, it is a new kind of, so communication tools have become more popular after COVID-19, and you can say it has started post global financial crisis. So, there it has been playing an important role. So, floor you can say here we have the reverse repo. So, here we have the SDF, special discount facility. It was introduced recently in 2022 or so, and then since then it has been there when they found that it is playing important role. So, reverse repo is this. So, SDF was launched. So, in SDF, you in case of reverse repo, you have to put a collateral with RBI when you are depositing money with the RBI. In case of SDF, you will not have to give money, or you don't have to go for any collateral. So, you can just keep money, but the rate of interest will be lower than the reverse repo. So, this is what it implies. And then repo is come in between, and ceiling, that here you have the marginal standing facility. So, here you have the floor decided by reverse repo and SDF, ceiling MSF, and in between is the liquidity adjustment facility, that we call it LAF. So, liquidity adjustment facility. So, adjustment for our repo rate is this side and adjustment is this side. So, this is what we call it as the liquidity adjustment facility. So, at the center here we have the repo rate, floor is the SDF, which is the reverse repo facility to park surplus liquidity. MSF is the overnight standing borrowing window, but it is higher than the repo rate. So, normally 1% higher than the repo rate. This is what we assume for the market stabilization facility. So, this is how it goes. Now, operation mechanism. Whenever RBI tries to manage the liquidity, so operation mechanism is that whenever RBI feels that the inflation denoted by pi is increasing, which means that money supply has to come down, and as a result we can also feel that the rate of interest has to go up. So, whenever we have inflation rising, rate of interest goes up, which means that repo goes up, and as a result we will find that money supply comes down. So, this is what is the one case, and SDF and are the corridor boundaries, which means that they are used in a special case, because these are extreme values. So, normally banks will play with RBI with repo and reverse repo. So, this is what it implies. And transmission path we have. So, what is the transmission path? Transmission path is that when repo rate increases, this leads to the money supply decrease. There will be a lot of disruption in the bond market, because new bonds will come with new repo rate. So, older bonds will be less in demand. So, then the RBI will have the operation twist kind of scenario. So, this is what here we have. Transmission path also, there are different types of transmission path, in the sense that when the rate of interest comes down, there will be credit channel, there will be household financing channel, investment channel. So, all those channels we will be discussing when we discuss. There is something called monetary policy transmission, right. So, this is what here we have. So, this is what it implies. So, when the repo rate is higher, your borrowing is getting costlier, demand cools, and as a result you can find that operation, which means that inflation lags, and this has a lot of role to play with this. So, this is what it implies. And now, after this, what we have is the standing deposit facility that here we have. So, standing deposit facility here, or you can say standing or a special discount facility also sometime it is called, but standing deposit facility is the proper definition. So, here RBI is standing uncollateralized facility to absorb surplus liquidity. If the banks are having excess money, then they can. It was introduced in 2002 and since then it has been working as the floor. No collateral required in the sense that banks can keep money, and it is mostly overnight by design, which means that overnight, and it is mainly meant for clearing the excess liquidity in the banking system. So, what has happened that post COVID banks are finding it difficult to lend all the money. So, the excess reserves that we saw, the required reserve plus excess reserve. So, excess reserve is being kept here in this form. So, this is where it is important. Then for example, if SDF is 6.25%, repo rate is 6.5%, margin standing facility is 6.75%, and bank has 2000 crore surplus, then SDF, the standing deposit facility that here we have overnight at 6.2%, no collateral is needed, and then they can also participate through the variable reverse repo operations, and they can, but in reverse repo operation they have to collateralize the G6. So, this is where it is important. Okay. And the only difference here is that in SDF you do not have to worry about, you will get the fixed rate and it is the lowest at floor. In this VRRR we go for auctioning and it is somewhere collateralized. So, if you do not want to keep a government bonds or you do not want to go for collateral lending, then you SDF special deposit facility is very important, or a standing deposit facility is very important, and if it is not, then here we have a VRRR which is helping to calculate. Liquidity adjustment facility, again the fixed repo, overnight it is again the injection, which means that you pump the money. When banks are borrowing money with the RBI, it means that they are RBI is giving them money. When banks are paying rate of interest on borrowed money, it means that they are allowed to use that borrowed money. So, that is what we are using. Fixed rate standing deposit facility that here we have, and reverse repo, it is for absorption, which means that banks are keeping money with the RBI. So, if banks are keeping their deposits with the RBI, it means that they have less of that deposit, right. So, it means that they will have less of money for lending and other purposes. So, in that case it is called absorption. So, here we are using the absorption and here we are using the injection, and this is what the liquidity adjustment facility looks like. Term operation, it is dealing with the duration, whether it is 7 days, 14 days. So, tenure that we see normally ranges between 7 to 14 days, and there are two types of channels. One is the variable repo rate and second is the variable rate reverse repo. So, this is VRRR or variable reverse repo rate you can say. So, this is what it says. Who all are allowed to participate? So, here we have the operational details. So, here participants are mostly the scheduled commercial banks, right, and the primary dealers are also allowed. Collaterals are mostly G6 and SDLs with no collaterals. So, SDLs will be only with the haircut, which means that a marginal amount of marginal rate will be marginal amount of cut in terms of rate of interest would be allowed, and that is what it is. So, this is what is the liquidity adjustment facility looks like. Let us take the example of VRRR, variable reverse repo or variable rate reverse repo auction. Suppose RBI announces a 7-day VRRR auction of 50,000 crore, right, and it asks for bids from the banks that please bid your rate at which you want to lend money to the RBI, or you want to keep money with the RBI with collateral, because it is reverse repo. So, there are 4 banks A, B, C, D. The total amount you can note it down, it is 50,000 crore. You can say that the first bank has quoted that they are ready to lend at 6.40, then the second bank 6.45, then the third bank is 6.50 and fourth bank is 6.55. As you can see, the RBI would prefer first bank A at 6.40 because it is a reverse repo. RBI has to pay rate of interest on this. So, 6.40 followed by 6.45 and then third one. So, how much? So, 50,000 crore is the only. So, 15, 10, 25 and 40. So 45,000 crore it has already been lent. The last one will be just getting 5,000 crore at 6.55, right. So which means that 15,000, so it is 20, 40, then 50, it is 65,000 crore request for deposit, but bank is going to auction only 50,000. So from the low rate they can go on a higher rate, and the last one will be just be able to lend money up to 5,000 crore with the RBI at 6.55%. But here you have a tweak. It may happen that banks are colluding with each other, that let's quote this rate and will not allow the VRRR rate to come down to some extent. So then they can control. There are studies talking about this, that how through game theory setup auctioning can be studied, and those auctioning with the VRRR can play. So RBI needs 50, so this is what it does, right. Partial allotment from D, 5,000 crore, it will be only from D. Cutoff rate will be just the weighted. So 10,000 into 6.540 plus 15,000 6. So what is the VRRR rate that we have? Weighted average rate, it is 6.47. So this is what here we have. VRR in the same way, a bank will be going for suppose 75,000 crore. So first 3, if it is matching, then they will be just going, and so 3, 5, so 75 crore. Because it is the VRR, it means that bank will look for the reverse case. It means that bank wants to RBI wants to lend bank which will be quoting higher rate. So it will start from higher rate and then go to the lower rate, and whenever it is touching the 75,000 crore, it will not give to the next. So in this case, till G cumulative, it is 75,000 crore. This is what the cumulative that you can see, and weighted average rate is coming out to be 6.65, and this is what it says about. So total amount auctioning is important, that how much amount RBI wants to lend, and then they will be going for bidding, right. So this is how it happens. Then so with this I would be saying that we will be stopping it here, and in the next session we will be talking about the quantity tool CRR and SLR. But I hope with this session you have been able to understand that RBI's case that you can see, it is not so easy. There are different types of instruments with which RBI has to manage the banking sector. Some are very liquid, some are of long term, some are very short term, some are also having 7 to 14 days, and even some are coming through special windows. The standing deposit facility is a new instrument introduced in 2022. And then since then we are seeing that the money market, because we are talking about money market, the short term money market deals with short term, less than 1 year scenario. So in the short run market, how monetary policy makes adjustment and what are the key variables which play important role. So these instruments are important to understand the commercial banking, because as we progress we will find that the instruments are used frequently to make adjustment with the banking operations. So in this course, which is about the introduction to commercial banking and fintech, these dimensions are extremely important. So I hope this will help you understand, and this has helped you. I appreciate your attention, and I'm sure these slides will be really useful to all of you and my lectures, and I request that you can again go on RBI and check what all details are available with RBI web page, and what all details are relevant, whether whatever we are explaining, are you able to get the same. You go on the first page, on the left side you will have the different rates mentioned that we are discussing, and on the front page you will find different types of auctioning happening. So you can see in practical way that how these things are being designed. You can go on also on the handbook of statistics on Indian economy or database on Indian economy, that also gives you a lot of insights about this. So with this I am stopping it here. Thank you so much for your attention. I really appreciate.